The market does not ruin most people when it falls. It ruins them when it shakes them hard enough to make them run for shelter, at the exact moment the future goes on sale. That is the brutal part you need to understand. You think the danger is the storm. Very often the danger is your reaction to the storm. I have watched this pattern for decades. A war breaks out. Oil jumps. Inflation stops behaving. Interest rates refuse to do what investors prayed they would do. Technology gets called a bubble. Supply chains tighten. Headlines turn theatrical. The public starts saying the same line with a different accent every cycle. This time is different. This time the damage is permanent. This time, and that is how ordinary people stand outside the door of opportunity and talk themselves into starvation. The stock market is not a comfort machine. It is a storm machine. It tests whether you are an owner or a spectator, whether you operate on weather or on value, whether you need emotional sunshine to buy productive assets, or whether you understand that the best terms often arrive under black clouds. Most people only want to own businesses when the sky is blue. That is exactly why they overpay. Then the wind picks up, the clouds roll in, prices come down, and they suddenly become very interested in safety. Not real safety, emotional safety. The kind that feels good for 2 weeks and costs you 10 years. I want to say this plainly. If you do not build a storm policy before the weather turns, the market will turn you into a coward on command. And cowardice in markets is expensive. I am not talking about the noble kind of caution that keeps a family from making stupid bets. I am talking about the kind that sells strong assets after a decline, waits for a perfect bottom that never announces itself, and then watches the recovery leave without you. That mistake has destroyed more future wealth than a lot of recessions. You need to understand something the public keeps refusing to learn. The market does not give out most of its long-term rewards in the calm middle of a bull run. A great deal of your lifetime return is decided in the ugly moments. The moments when your stomach hurts, your phone is full of panic, and the story on television is that civilization just hit a wall. That is when prices stop being flattering. That is when the storm discount appears. And if you do not know how to behave when the storm discount appears, you will spend your entire life buying sunshine and selling rain. I have no interest in that way of living. Neither should you. Look at the pattern that keeps repeating. In one cycle, a geopolitical shock shoves energy and food prices higher, supply chains seize up, inflation burns hotter than expected, and expensive technology names get repriced all at once. People decide the whole game is broken. Then a couple of years later, after the fear, after the liquidation, after the self-righteous speeches about caution, the market has already recovered and run much higher. Then another cycle arrives. Again there is conflict. Again oil becomes a pressure point. Again the public rediscovers that shipping, transport, fertilizer, and food do not magically move themselves across the planet. Again, technology carries too much optimism and gets accused of being a bubble. Again, the central bank refuses to deliver the cuts people already spent in their minds. Again, investors who were counting on lower rates discover that hope is not policy. Again, headlines start behaving like air raid sirens. The details change. The emotional script does not. This is why I care more about behavioral structure than short-term prophecy. You do not need me or anyone else to tell you the exact day a storm begins. You need a structure that tells you how you will behave when the barometer drops. That is a very different problem. Most people pretend they are asking for forecasts when what they really need is discipline. They want certainty because certainty feels like shelter. But ownership does not reward certainty. Ownership rewards rational behavior under uncertainty. If you miss that distinction, you will spend your life renting conviction from louder people. I do not invest that way. You should not live that way either. When I buy productive assets, I am not buying a weather report. I am buying future cash flows at a certain price. If the storm knocks the price down while the long-term earning power is still intact, that is not a tragedy. That is a markdown. If the public treats every gust of wind as permanent climate change, I get interested. That does not mean I become reckless. It means I become useful to myself. That is the part most people get backward. They think being calm in a storm means pretending the storm is not real. Nonsense, the storm is real. Oil can spike, freight can get more expensive. Fertilizer costs can rise, tariffs can jam supplier networks, inflation can stay sticky. The Federal Reserve can refuse to cut when traders have already built a fantasy around easier money. Technology shares can absolutely be repriced when valuations ran too far ahead of the cash they will produce in the near term. All of that can be real. What does not follow is the public conclusion that you should turn a temporary storm into a permanent surrender. That is where the money is lost. I have seen people do this in every generation. They tell themselves they are being prudent. What they are really doing is translating uncertainty into paralysis. They sell because they want the pain to stop. Then they set a trap for themselves. They say they will buy back in when things look clearer. But storms do not end with a trumpet. They end by confusing you. That is why I call it the re-entry trap. Prices drop. You sell, the market finds a bottom while everybody is still depressed. Then prices rise just enough to make you suspicious. You say it is a false rebound, then they rise more. You say the market is irrational, then they rise again. You say you will wait for the next pullback. Then 1 year becomes 2, then 2 becomes 4. Eventually, you are not managing risk. You are managing regret. And regret is one of the most expensive portfolios ever assembled. A lot of people think the greatest investing mistake is buying too early. For a speculator using borrowed money, that can be true for a long-term owner using disciplined allocation. The more common disaster is refusing to act when prices are finally lower, because fear has convinced you that lower must become catastrophic. You need to be very careful with the stories you tell yourself during storms. The human brain is built for immediate survival, not compounding. When markets fall, your mind starts converting volatility into threat. It stops asking, "What is this business worth over 10 years?" and starts screaming, "How do I make this feeling end before dinner?" That is not rational capital allocation. That is the nervous system bargaining with a screen. If you let your nervous system run your portfolio, you will get short-term emotional relief and long-term financial punishment. I would rather reverse that. I would rather accept short-term discomfort in exchange for long-term financial freedom. That is how ownership works. Now let us talk about the storm itself. Because this matters, a real storm has fronts. It does not arrive as one neat headline. One front is geopolitical tension. War is not just a tragedy on a map. In markets, war becomes pressure in pipelines, shipping lanes, insurance costs, commodities, fuel, freight, and food. Most people notice gasoline because they see it on a sign. They miss the deeper spread. Trucks move with fuel, ships move with fuel, planes move with fuel, farms depend on fertilizer. Fertilizer depends on feedstocks and regions the public barely pays attention to until the price of food starts talking back. That is the first front. The second front is valuation compression. When money was easy and optimism was abundant, a lot of investors stopped distinguishing between a great business and a great stock price. Those are not the same thing. A company can be wonderful and still be overpriced. When fear hits, the market suddenly remembers arithmetic. It revalues duration, growth, and uncertainty. Businesses that were being priced as if tomorrow was guaranteed start trading as if tomorrow needs proof. That is not market madness. That is the storm stripping away costume jewelry. The third front is monetary disappointment. This one hurts because it attacks expectations. Investors build castles out of anticipated rate cuts. They imagine easier money, lower discount rates, better multiples, friendlier borrowing conditions. Then the central bank looks at inflation, looks at the economy, and says no, or at least not yet. The public hears one sentence. The market hears gravity. That mismatch between expectation and policy can hurt as much as the policy itself. The fourth front is supply chain friction. People speak about supply chains as if they are some abstract business school chart. They are not abstract. They are living arteries. They can clot a conflict in one region, a tariff fight in another, a shipping disruption somewhere else, and suddenly inventory, pricing, margins, and availability all start bleeding into one another. When businesses cannot source cleanly and cheaply, consumers eventually feel it. They always feel it. And then there is the fifth front, psychology. This is the front that almost nobody models well because it does not live in spreadsheets first. It lives in people. It lives in the couple that stops investing right after prices fell because they want to see what happens. It lives in the worker who had no written plan and now decides every headline deserves a portfolio response. It lives in the retiree who mistakes temporary declines for permanent incapacity. It lives in the younger investor who says he wants bargains and then panics the first time the shelves actually look discounted. Psychology is where storms finish their real work. They do not just move prices, they move people, and the people move the prices even further. If you want to protect yourself, you need a concept more powerful than courage. Courage is unreliable. It comes and goes with sleep, health, news flow, and blood sugar. You need systems. I like systems because systems keep making good decisions after emotion gets stupid. That is why I have always respected written rules, clear allocation logic, and enough liquidity to avoid being forced into dumb behavior. A lot of people think successful investing is about superior intelligence. In ordinary households, it is usually about superior structure. A mediocre investor with a durable structure beats an emotional investor with better opinions every time. I want you to understand the hidden mechanism that turns storms into gifts. It is simple. A bear market does not just lower prices. It changes the terms of future compounding. That is the whole game. If you buy a broad collection of productive businesses when prices are lower, your forward return improves. Your dividend reinvestment buys more shares. Your same monthly contribution buys more ownership. The future recovery, when it comes, compounds on a larger share base. That is how storms plant seeds for later abundance. The public sees a storm and asks, how much more could I lose this month? I see a storm and ask, how much future ownership can the same dollar buy now? Those are two different species of thought. One produces panic. The other produces wealth. Now, I need to be careful here because people like to turn every serious idea into a slogan. Buying into a decline is not a command to behave like an idiot. It is not a command to ignore your household balance sheet. It is not a command to go all in because prices are lower than they were last month. It is not a command to buy trash because it is cheaper trash. The storm discount only matters if three things are true. First, you are buying productive assets, not fantasies. Second, you have time. Third, you are using a plan, not adrenaline. Miss any one of those, and the whole exercise becomes far more fragile. This is why I say the most important investors in a storm are often two groups who seem opposite. The first is the newer investor. The second is the investor near retirement or already in it. The new investor matters because time can do so much of the heavy lifting if the behavior is right. A storm early in your ownership life is not bad luck. It can be a gift disguised as insult. Your contributions are still a large part of your total capital. Lower prices let those contributions buy more. You are not harvesting yet. You are planting. Planting during markdowns is how ordinary people quietly build extraordinary outcomes. But newer investors are fragile because they mistake lack of experience for lack of capacity. They see a falling market and think they discovered that investing is dangerous. No, they discovered that investing includes weather. That is different. The investor near retirement matters for a different reason. At that stage, the question is not simply how much return you can make. It is how much sequencing risk you can survive without breaking your life. If you are close to drawing from the portfolio, storms matter more because the order of returns matters more. A bad decline combined with forced withdrawals can permanently damage the capital base. So what do? You do not pray. You build a harbor. That means you separate short-term spending needs from long-term ownership capital. Money you need for near-term withdrawals should not be dressed like bravery and thrown into the surf. A retiree with proper reserves, sensible fixed income exposure, and a clear withdrawal framework can let the equity portion breathe. A retiree without a harbor turns every storm into an emergency and every emergency into a bad sale. Do you see the pattern? Storms do not expose prices first. They expose structure. If your structure is weak, the weather feels fatal. If your structure is strong, the weather feels inconvenient and sometimes even useful. This is why I have no patience for improvisation as a financial philosophy. People call it flexibility. Usually it is just undisciplined fear wearing a smarter suit. You need what I call a storm policy. Not a mood, not a hope, a policy. A storm policy is a written set of rules that tells you what you own, why you own it, how much cash or short-term safety you keep, what you buy when prices decline, what you refuse to do, and what evidence would actually justify a change. Without that document, every bad week becomes a negotiation with your emotions. With it, bad weeks become execution. Execution is what owners do. Drama is what spectators do. I would rather you be boring and rich than emotionally stimulated and financially fragile. Now, let me say something uncomfortable. A lot of people never get rich because they are addicted to weather commentary. They call it being informed. Most of it is just intellectualized anxiety. Every day they scan headlines, analyst notes, social media posts, emergency threads, hot takes, and dramatic market calls. They are not building ownership. They are renting panic by the hour. Then they wonder why their behavior deteriorates precisely when opportunity improves. You cannot compound if your attention is permanently hijacked. Attention is capital before capital becomes capital. If you lose control of the first, you often misallocate the second. That is why automation matters so much for ordinary investors. Automation is not just a convenience, it is a behavioral shield. A fixed schedule into broad, low-cost ownership vehicles removes a great deal of your worst instinct from the process. It turns storms from moments of decision into moments of accumulation. That is powerful. If you are always deciding, you are always vulnerable. If you already decided in writing, the storm has fewer places to enter. This is also why I am suspicious of people who insist on calling the exact bottom. Bottom calling is one of the most expensive entertainments in finance. It flatters the ego and starves the account. By the time the exact bottom is obvious, the bargain has already improved the balance sheet of the disciplined investor who kept buying through the decline. You do not need to catch the lowest raindrop. You need to keep owning through the weather. There is a mathematical reason for this that ordinary people underestimate. Returns are lumpy. Recoveries are front-loaded. The market often turns when the news still looks miserable. Miss a small handful of powerful rebound periods, and the long-term compounding profile deteriorates badly. So when a frightened investor sells and waits for clarity, he is not just risking a delayed re-entry. He is risking missing the very segment that changes the decade. That is the waiting tax. The market charges it to people who worship confirmation. And confirmation is always expensive because it arrives after risk is already repriced. I want you to build a different habit. When the storm hits, do not ask, how do I make the forecast disappear? Ask, what part of my plan was designed for exactly this weather? That question changes the entire tone of your financial life. It moves you from victim to operator. Operators do not need to feel cheerful. They need to know the checklist. Here is what I would want an ordinary household to understand in a period like this. First, separate survival from investing. If a market decline threatens your rent, food, debt payments, or next 6 to 12 months of stability, that is not an investing problem. That is a balance sheet problem. Solve survival first. Build cash reserves, cut fragility, get high-interest debt under control. Strengthen the household foundation. Nobody compounds well while standing on rotten floorboards. Second, know your distance from the money. Money needed in the near term should not be mistaken for long-term capital. If you will need it soon, protect it appropriately. If you will not need it for many years, do not insult the future by treating temporary fear as permanent truth. Third, automate contribution behavior. A storm is exactly when you least want your monthly investing behavior to depend on your courage. Remove courage from the loop. Let the schedule work. Fourth, use low-cost broad ownership as your default. Unless you have a real edge. Most people do not need more complexity. They need more discipline. Broad, low-cost index funds or ETFs tied to productive enterprise are already a powerful machine when fed consistently through ugly markets. Fifth, write your decline rules in advance. At what percentage decline do you add? From what reserve into what assets? Under what conditions do you pause contributions? If ever, how much cash do you keep to preserve sleep without sabotaging returns? Those answers should exist before the weather gets loud. 6. Decide whose voice gets a vote. If your portfolio can be emotionally reprogrammed by any random person with a microphone, you do not own a system. You own a weather vane. That is not enough. Now let me address the lie people tell themselves after they sell. They say, I will get back in once things stabilize. No, you will not. Not easily. Because stabilization itself will feel then prices will be higher and you will resent paying more. Then you will start hoping for another drop. Then the drop will come and you will be too scared to use it. Then you will find a smarter sounding reason to wait. Then the cycle will harden into identity. You will become one of those people who are permanently researching entry points and permanently under-owning productive assets. That is not caution. That is self-exile. I have very little respect for self-exile as a wealth strategy. You must also stop confusing information with edge. Everybody can see war headlines. Everybody can see oil quotes. Everybody can see rate expectations moving around. Everybody can scream about technology valuations. That is not the edge. The edge is behaving rationally, while other people let those facts disorganize them. Behavior is the edge. It has always been the edge for ordinary investors, and the reason it remains the edge is that it is psychologically hard. It sounds simple in calm weather, and feels nearly impossible during storms. That is why so few people capture the full benefit of bear markets. They want the returns that storms make possible without enduring the discomfort storms require. That trade does not exist. The public wants harvest without bad weather. I want you to stop thinking like the public. There is another subtle danger I want to warn you about. During storms, people overestimate the precision of near-term macro analysis and underestimate the durability of large productive systems. Yes, wars matter, inflation matters, policy matters, supply chains matter, but a broad market of productive enterprise is not a delicate ornament. It adapts, costs get passed. Supply chains get redesigned, pricing adjusts, management teams respond. Weaker competitors break first, survivors absorb. Innovation does not vanish because the news cycle got ugly. The economy is not a photograph. It is a living organism. If you buy it only when it looks beautiful in a still frame, you will keep paying too much. Buy it when it is bruised but functioning. That is a better trade. And when you do not demand instant gratitude from the market. A storm policy must include emotional patience. Sometimes the market will fall further after you buy. Fine, that is not an insult. That is weather continuing to be weather. If your thesis is long-term productive ownership and your structure is sound, a lower price tomorrow is not proof you were wrong today. It is simply another day in a storm. Most people cannot handle that sentence, you need to, because the demand for immediate validation is one of the costliest weaknesses in money. Immediate validation is a luxury good. Owners cannot afford too much of it. Now let us talk about retirement again, because a lot of people in or near retirement hear a message like mine and misinterpret it. They think I am saying they should be aggressive just because prices are lower. No, I am saying they must distinguish between volatility and insolvency. A retiree does not need swagger. A retiree needs design. If the design is right, the equity portion can recover while the near-term spending is handled by safer reserves. If the design is wrong, even a temporary downturn feels like an identity crisis. That is why the harbor matters. You cannot improvise a harbor once the boats are breaking. If you are younger, your harbor can be smaller and your storm participation larger. If you are older, your harbor must be more deliberate. But in both cases, the principle is the same. Build structure so the weather cannot force a betrayal of your long-term plan. I want to name one more mechanism because it matters enormously. I call it the sunshine penalty. The sunshine penalty is what happens when you only invest with confidence after markets have already recovered. Optimism has returned, and everyone around you once again feels clever. You get emotional ease, but you pay for it with a higher entry price, lower future return, and often a false sense of safety. That is what most people do. They need social proof, upward charts, and cheerful narratives before they can act. So they keep arriving late to the party and leaving early from the sale. That is not bad luck. That is a habit. Habits write financial biographies. If you want a different biography, you need a different habit. You need to become the kind of person who can recognize that storms are not pleasant, but they are often where terms improve, not where certainty improves, where terms improve. That distinction is worth a fortune. I also want you to understand that a storm policy is not just about buying, it is about refusing the wrong actions. Refuse leverage you do not need. Refuse panic sales. Refuse portfolio surgery inspired by 1 week of headlines. Refuse to confuse the noise of news with a signal of value. Refuse to let inflationary fear drive you into speculative nonsense that merely sounds protective. Refuse to let a bad quarter erase a good decade. Refusal is part of ownership. Sometimes the intelligent move is not an exciting move, it is a disciplined non-move. That is why I like written policy so much. It turns refusal into procedure. Procedure is how ordinary people borrow a little bit of institutional strength. I have lived long enough to know that financial freedom is not usually built by dramatic acts of genius. It is built by repeated acts of rationality in environments designed to provoke irrationality. Storms are one of those environments. They test whether your mind works for your capital or against it. You should assume before the storm starts that your mind will try to betray you. That is not pessimism. That is preparation. Once you assume that the design gets better, the cash buffer gets more honest, the allocation gets more appropriate, the automation becomes more valuable, the headlines get downgraded in authority, the written rules get clearer, the need to call the perfect bottom starts looking childish, the whole game becomes less theatrical and more effective. That is how wealth is usually built, quietly, systematically, with less drama than the public expects and more discomfort than the public tolerates. I do not know the exact path of the next 6 months. I do not know whether this storm gets sharper before it gets better. I do not know whether technology falls more before it recovers, whether rate expectations shift again, whether tariffs intensify, or whether energy pressure eases faster than feared, and I do not need to know. That is another thing you need to outgrow, the idea that profitable action requires detailed near-term clairvoyance. It does not. Profitable action requires sound probabilities, durable structure, and emotional discipline. When the market gives you lower prices on productive assets because people are scared of weather they cannot control, you do not need omniscience. You need a plan and enough character to follow it. That is all, and that is a lot. Because most people never develop that character. They want certainty more than they want wealth. They want comfort more than they want ownership. They want forecasts more than they want a framework. Then they wonder why the patient owners, the boring owners, the disciplined owners end up with such disproportionate outcomes. It is not magic, it is behavior under pressure. That is all compounding ever was. A system of rewards for behavior most people cannot sustain long enough. So here is the final test. When the storm hits harder, and it may, what will you actually do? Will you stare at the radar, wait for unanimous permission, and pay the sunshine penalty once the clouds clear? Will you sell to feel safe, enter the re-entry trap, and spend the next few years pretending that caution is why you missed the recovery? Will you treat every headline like a command and let your nervous system run your net worth? Or will you build a harbor, write a storm policy, automate your ownership, separate survival money from compounding money, and use the weather that terrifies other people to improve the terms of your future? That is the door. You are standing right in front of it. The storm is not asking whether you are optimistic. It is asking whether you are organized. It is asking whether you are a buyer of weather or a builder through weather. It is asking whether you want emotional shelter for a season or financial freedom for a lifetime. Choose carefully. The sky does not stay dark forever. But the price you pay for your behavior during the dark can follow you for decades.